Hey traders, Abel Delgado, market insights commentator at Global Prime Forex. In this video, I'm going to be introducing 3 indicators that are going to be vitally important for your trading. Okay, so let's get started. First of all, right off the gates, I'm going to introduce these 3 indicators. Number 1 is the Daily Atr. The second one is one that I call Sweet Spots Gold, which actually refers to plotting round numbers in your chart. And the third one is the swap spread for chart symbol. I'm going to be walking you through these 3 indicators and how they can actually help your trading. They are very simple to actually embed in your chart, and once you've done so, you will start noticing some critical information in your chart that otherwise would be overlooked, and it might be detrimental for your own trading. Okay, so with that being said, let's get started. The first indicator I want to be touching on is the round number lines, round numbers lines. Okay, now these are the lines that you see here in the chart plotted with purple. Okay, so this is the GBP US dollar on a 30-minute, and you can see here how the 1.30 has been marked, 1.31, 1.32. Below we have the 1.29, 1.28, and so forth as we go upper or lower in the chart scale. Okay, now key levels in Forex tend to draw a lot of attention by traders. Okay, the reason being is because by its very nature, they actually act as psychological prices with, these psychological prices tie into the human psyche and the way of thinking by traders. Okay, now the way that they work is that these psychological levels are market price levels, which are often, as I said, key levels in Forex, denoted by, as I said, these lines. Okay, and these round numbers are going to be frequently acting as support and resistance. And you can see here in the chart of the GBP US dollar how many interactions the price, either through wicks or through closes, has with these purple horizontal lines, the round numbers. Okay, you can see here, allow me just to grab real quick the drawing tool, and we will go through a very quick demonstration. Okay, so you can see here right from the very bottom of the chart how the 1.28 was acting as a level of resistance and support depending on what side the price was at, and as we were rising we got into the 1.29, and the interactions were very clear. Here you can see that the market actually broke through, and it actually eventually acted as a springboard for the market to travel all the way to the 1.31. Yesterday's price action saw the pound skyrocketing to what level? You guessed it, 1.32 to the pip, and after rebounding, after pulling back, it then found 1.31 as that horizontal level of support. Okay, so bottom line is that round numbers are going to be these psychological support and resistance levels that are going to be consistently working in your favor to kind of just strengthen the case of putting into a buy or sell order with sufficient accuracy, if obviously combined with other factors, with other technical measurements that as part of your system. Okay, what else? Now the reason that I mentioned that they tie very closely with human psyche and the way that we as traders think is because human beings, at the end of the day, it is my belief that we value simplicity. So from a trading perspective, this means that valuing whole numbers, valuing round numbers is going to be extremely important just because of its simplicity. And also don't forget that big institutions, commercial banks, and commercials themselves, that is the ultimate producers of the commodity or the ultimate users of that currency, those that are going to have their interests at heart to actually be hedging these currencies or whatever other commodity or metals you're trading, they're going to be actually looking also at these round numbers as well as entry, exit, or stop levels. Okay, now in my opinion, I believe that the main advantages that it has to actually monitor round numbers is going to be the fact that they're acting as fairly reliable support and resistance areas. At the same time, it's very easy to identify an eyeball just because they are fixed and they're not going to be variable, like a trend line, for example. And they can actually also be implemented in all types of instruments, in all types of markets, okay? And the downside, or something that obviously you have to be aware of, is that they are not going to be always 100% reliable. So essentially, you're going to have to, at times, obviously factor in other elements, other factors as well, okay? It's not going to be the holy grail, far from it, but as I demonstrated in this video, it's going to give you that extra value when it comes to your technical analysis. And yeah, as I said, it's best when used as a guideline in conjunction with other technical measurements, other technical your technical analysis, okay? So that's the first indicator. Now the second one that I wanted to touch on is this blue dotted lines that you see here in the chart plotted every single day. Now this is what I refer as the Daily Atr. If you come to the indicator, it is actually called by the same name, Daily Atr. And it is very important that as traders we use volatility measures to improve, you know, either order placements or market analysis, the type of profit targets, how aggressive we want to be, etc. Now this Daily Atr indicator is going to be giving us the limits of potential price projections to the upside and to the downside based on the average movement of this currency pair based on a specific period that you're going to choose, okay? Since we've had massive market volatility, I have adjusted this to a period of 10. You can obviously adjust that to just a period of 5, so that is going to most likely expand these lines a little bit, just because in the last 5 days we've seen volatility massively increasing. But I would say that as a rule of thumb, 14 period is the one that you might want to stick with, 10 to 14. If the volatility, you notice that is starting to increase quite significantly, perhaps 10, okay? There's a little bit of trial and error, so to each its own. And I would say that this ATR indicator is going to be very, very important. It gets calculated as each day passes. So, you know, it can actually be calculated from different time scales, but the one that really matters here is on a daily chart, okay? So a new ATR is going to be calculated at the end of every single day. And as I said, all these readings are going to be plotted to form this continuous lines at the end of the day. And again, as a demonstration, you will notice that this is not going to be repainted, so it's going to give us the accuracy of what was the limit to the upside and to the downside based on the measurements of volatility that were expected. So let's just begin, let's say, by the beginning of March, okay? We've gone through a couple of weeks of March. So notice here that the top side limit based on ATR was right there, which the price went to. It actually poked through for a couple of 3 pips, and then it went down and found support again at the daily ATR. The next day we see that the price actually raised did rise all the way to the daily ATR, almost to the pip. Again, this is not being repainted. Here the daily ATR, allow me to just delete that, was telling us that 106 pips would be the expected range based on a 10 period average true range. Average to a range, yeah. Okay, based on the volatility. And if we calculate the number of pips the market traveled north from the bottom to the top, it is 106. Okay, now the next day, notice that the price went up and fell short by 1 or 2 pips. And so from the bottom to the top, it went up for about 105 or 106 from the expected 109 pips. The next day, we had an expectation of 107 pips based on the volatility measurements, and from the bottom to the top it met the volatility target, and then it pulled back a little bit. The next day, again, we had expectations for 110 pips, and notice that the market did go for 110 pips, and then it retraces. And yesterday, being Monday, obviously we had a lot more chaotic price movements, a lot of wild swings here, so it did break through. But notice that on the way back, as the market started to stabilize, it did find that resistance of the daily ATR. So again, as I mentioned with the round numbers, the daily ATR is yet another essential tool that you want to place in your charts, which is going to help you massively. As day traders, you can use these lines essentially just to give you that information on how much an asset typically moves in a certain period for, plotting profit targets and determining whether a trade should be attempted or not. And the reason that I'm saying that is because imagine that you want to go long, let's just say that you want to go long the market at this point, knowing that not only we are in a downtrend, but you have reached the limit ATR for the day, okay? Or you want to go long here. You have already traveled the amount of pips expected for the day, and your strategy is going to give you a buy side signal at that point. Well, that's going to be fairly self-defeating as a strategy if you're going to be getting signals at a point in time that is most likely to be an inflection point in favor of the sellers rather than in favor of the buyers, okay? Or for example, what about if yesterday you did get a signal to enter long somewhere above this ATR? What would happen essentially is that you would be going long a market that has already exceeded the volatility expected for that day. And not only that, but you would also be looking to trade into that 1.32 round number. If you were to remove these indicators from your chart, the daily ATR and the round number, you would be oblivious, you'll be blind to the fact that you are entering a trade once the volatility measurements have gone out of whack, or knowing or without knowing that you are actually trading straight into 1.32 as the round number, okay? So be aware of that. At the end of the day, you want to be smart as a trader, and you want to put yourself in a position that you're going to get the best deals. The daily ATR, the round numbers are going to give you great information for you to make wise decisions as a trader, okay? Now, the final indicator that I want to touch on is the one that you see at the top right hand side of my chart. This is essentially just very simple information about the swaps and the spread on every single currency pair that you're going to be attaching this indicator into, okay? Now remember, swaps and spreads are two of the biggest forex trading costs that you will incur as a trader, okay? Fortunately, at the Global Prime, we keep it very, very tight in favor of the traders. We always want the best conditions for the traders. We obviously, as a trader, we have a business model to maintain, and that is just essentially running an A-book, not a B-book, but a real A-book, and we're just going to be charging a very small commission of the trader. But at the end of the day, you really want to get this information available as as visible as possible. So by attaching this indicator, the swap and spread indicator, in your chart, you're going to be definitely better equipped to have that information that is going to be critical for you, because without it, it obviously can affect negatively your account balance, just because you might be holding a currency pair that has negative swaps and you being oblivious of it. So you really want to obviously get that information right from the get-go and having it visible at the very top of your chart is definitely going to be something that will kind of like simplify things for you to gain access to the information that really matters. Okay, it's important that you understand when and why you will incur fees as a trader. So as I said, spread is something that you will have to be paying depending on the liquidity of that currency pair. In the euro US dollar being a major, it is very tight, and as we move into exotics, it's obviously going to be a little bit larger, that spread. And obviously then we have the swaps. The swaps are going to be actually charged at the end of every single day, and you will either be paid or be charged interest on your positions. We can have here an example of the GBP US dollar. If you were to be holding a position overnight long GBP US dollar, so you buy the pounds and sell the US dollar, you're going to be incurring a negative swap of minus 3.87 Australian dollars per every single lot. And if you want to be sure and hold the position overnight, every single day that passes, you will be then get paid 1.18 Australian dollars per lot, per one lot. Okay, so the very definition of a SWOT at the end of the day, remember that is going to be the difference between the different interest rates that a currency pair has, and that is something that gets set by the central bank. All right, now remember that you have full access to these indicators free of charge. I'm going to be providing the link down in the description box, and also don't forget that if you want to help me keep growing this channel, hopefully it's a channel that you gain value from, don't forget to actually make comments in the description, below the description box. Also remember that you can click the notification bell if you want to be at all times notified of my new content. And please, if you want to really go the extra mile, just click the like button and help, as I said, this channel to keep growing and being more present in people's search engines through YouTube. Okay, that's going to help me massively. Okay, so I would really appreciate that. All right, so Abel Delgado, it's time for me to wrap it up for today, and I'll see you in the next video. Cheers.